So African Bank's H1 performance of 2023, as a group, we ended up on a loss after tax of 44 million rand. If you had to unpack our performance, you would notice that we had high revenue growths, and that unfortunately was offset by our high credit impairment charge. So I've already spoken about what has generated our high revenue growth. When we unpack our credit impairments, you will see that as an economy and as a consumer, we've experienced strain. We've also seen that our consumers have been impacted by hyper-food inflation, transport inflation, and also the energy crisis. We've also noticed that our consumers' affordability, or what we call share of wallet, has decreased, which means their ability to repay the loans has diminished. What that translates into from a consumer banking perspective, or from our group's performance perspective, is that our impairments have increased because our consumers' ability to repay us has not been there. The bank has seen the risk emergence and has seen how our customers have basically been unable to repay their loans. And what we have done is we have tightened our scorecards throughout H1 2023. We have also re-looked at the credit criteria of issuing loans going forward. So from that perspective, we've also covered that. We've also noticed, as I mentioned, the strain. We have continued to provide for the impairments, and hence we have increased our coverage ratios on the non-performing book. And the non-performing book has a coverage ratio now of over 70%. In this in tough economic time, obviously is very good, but it also has impacted the bank's performance around profitability, and hence we've ended up on a loss. What we're doing going forward is we're trying to diversify our revenue streams, and as I mentioned, we will be focusing more on increasing our non-interest revenues, growing that, and at the same time, when we are issuing credit, to be more conservative, more direct in terms of the type of credit risk that we are willing to take in terms of a risk appetite, and also diversify our products and make sure that our customers are using more credit card, overdraft, and the short-term loans rather than the longer dated products in terms of our unsecured loans. And those are the measures taken for us to ensure that the loss that we've incurred for the first 6 months doesn't actually repeat itself. I think one of the biggest outliers is really our credit impairments. It is a big number. We are confident and comfortable that the impairments that we have provided to cater for this cohort of risk, or the stressed vintages as we call it, is sufficient. Will we see this continuing in the future? I think from a consumer strain perspective, in the medium term, we will see it. And obviously, from our perspective, we will react to it by ensuring that our credit granting criteria is sufficient and within risk appetite. And from an impairments perspective, we will ensure that we have sufficient coverage to make sure that the bank and the loans exposures are well covered from an impairments perspective.